Hello and welcome to Money Control. As we get closer to the election verdict, we kickstart a new Money Control conversation series on how to navigate this crucial time in the market. We are in the last leg of the general election 2024 and the countdown to the election verdict begins now with the date of counting just 1 week away. So far, the market seems to be in a happy mood. Does this signal a good election outcome? How do you position yourself at this stage to protect yourself from any risk as well as to take advantage of any opportunity the market throws at us? I'm Mahalakshmi and I have with me Andrew Holland, CEO of Avendus Capital, who joins me today to help us devise a strategy to navigate this very crucial time. Thank you so much, Andrew, for joining me this morning.
Oh, it's a pleasure. Thank you for the opportunity.
So, Andrew, first off, what is your sense on what kind of verdict are we expecting? What kind of verdict is the market expecting?
Yeah, so the market's obviously become a lot more confident regarding the kind of incumbent government continuing. Now, we can debate on the kind of margin and so forth. And I think that's what the market's been trying to do. But it seems to be voting with its feet at the moment. In terms of the market making new highs despite the FII selling. But I think the big impact on the market was actually the RBI dividend, which to my mind was huge, great for the banking sector, great problem for any government to have in terms of to reduce your fiscal deficit, which will anyway reduce bond yields and obviously from a sovereign wealth perspective, Moody's and the other rating agencies will have to look at very closely. Or do you spend, we're all kind of comfortable anyway with the fiscal deficit going forward, and therefore you could, kickstart the continuation of the infrastructure spending that the government's been doing. So I think the combination of these factors, Mahalakshmi, is kind of just giving that extra boost to the market. And one of the big laggards, as we all know, has been the banking sector. And that's been a nice fillip by the RBI dividend to the government, which if it brings down bond yields, which could be the case in June, with obviously the inclusion in the JP Morgan bond index, would be good for banks in terms of their government holdings as well, in terms of bond yields falling and prices going up.
Oh, absolutely. This 2 lakh crore bonanza is definitely something I wanted to talk about. But before that, I want to get this election thing out of the way. So are you suggesting that the election risk, the market at least suggests that the election risk is somewhat over?
Yeah, I'm not saying it's over because obviously there's going to be, I'm sure, some kind of rumors around, but I think from those early days of worries about the voter turnout and when that was kind of corrected by the real kind of turnout, I think that gave the market some more confidence, and that's what we've been seeing now in terms of the sectors which were probably the big beneficiaries of the government continuing and the policies continuing. You've seen some big moves in those sectors, which is indicating that investors are getting more comfortable.
Correct. All the questions I wanted to ask you're already answering. So, but back to elections, is there a threshold number that you have in mind that you think the markets will really react adversely to? And on the contrary, is there a number that you would say beyond that will set off a fresh rally from here on?
See, it's very difficult to guess what the market's gonna like or not like. I think what the market wants is no uncertainty, continuation of the policies, and if they get those two factors, then they'll be happy. It'll be a happy market, that's for sure.
Sure. Is there any way of for you to lay down the different scenarios and a probabilistic kind of if you can lay out everything probabilistically? What do you think? For example, is the probability of a 20% up move post-election and a 20% down move for this year? So that should be an easier question to answer. Then we can narrow down the time frame and look at other scenarios.
Mahalakshmi, the way I'd answer this is maybe not exactly pinpointing in terms of the answer, in terms of index movements. But what I would say is that if the market will probably do all of its kind of up move this week, if the market's believing that it's going to be a good result for the incumbent government, and I think that's what you'll have to look at. So when it comes to like the 3rd of June, 4th of June, we'll probably have the exit polls and a lot of the hard work the market would have done, depending on whether it's a surprise to the downside or the upside. But a lot of the market will be moving this week, is to my view. Thereafter is the key, right?
Yeah.
Is what is the budget going to be like, and is it going to be anything to do with capital gains tax? And we talked about this before. We keep hearing that there could be something on capital gains tax. Now, whether that's duration in terms of holding stocks for longer or whether it's an increase, don't know. But that could be one of the things which would kind of have the markets concerned in the very short term after the elections.
Sure. So, the Prime Minister Modi has said that, on 4th of June, we are going to see a new high. The market will climb higher. Do you think that could set off a kind of a peak before elections? Because will that be the point from where nervousness about the budget will begin? Or that depends upon the verdict itself?
Yeah, I think it really depends on the verdict itself. For that day of the election results, of what kind of magnitude the market moves. But thereafter, again, we'll very quickly think about two things: the first 100 days of the government and what they're going to be doing, and then next would be what's in the budget and what's going to be of any concern, if anything.
Sure. Tell me, if the market gets an outcome like 270 seats for BJP and 340, 350 for the NDA, that's pretty much on expected lines. It's neither here nor there. It's something that the market will very happily take. Will that set off a 5-7% rally from there on? Is it possible? Or, market will just take that and thereon you're just, starting to look at the budget?
Well, actually, it depends on how much the market rises this week ahead of those.
So there is
those numbers.
So it depends really on the market level. Sentiment itself will not do any, incremental rally from there on. Is that what you're saying?
It could well be, unless there's a big surprise on the upside, which the market hadn't been expecting. That could further lead to markets moving higher. But we would then have to wait for the policy for the next 100 days and then the budget. Those are the two key events, I think, after the elections, which the market will focus on very, very quickly.
Okay. Andrew, one question again on the event is, how do you cover for any potential risk, and how are you doing it in your own funds? You also have this long short fund. Have you hedged yourself for any potential risks that emanates from that day? Or have you increased any cash position to create room for extra buying in case there is a correction that comes in? How are you playing it?
So again, Mahalakshmi, I think this week is a crucial week, and I think we'd rather kind of think about this week rather than positioning for a day of the election results. I think by the end of this week we'll be looking again and saying what is the market saying to us, and what are the expectations that market's kind of pricing in. At the moment, I think the market was not pricing in the RBI dividend for banking sector, and it's been a hugely underperforming sector. So, and as you know, foreign investors have been using this as a sector which they've been either shorting or using as a way of funds to invest in China. If they come back, they're going to have to come back and up their weights in the banking sector. So I think that's the catalyst. I think the market's moving on at the moment, as well as optimism from where we were a few weeks ago in terms of the elections.
Sure. And you talked about FII selling, which has been true, but except for the last two sessions on Thursday and Friday, we saw quite some purchases from FIIs. Do you think there is money waiting on the sidelines only to avoid this event risk that could flow in just after election if the outcome is good?
So yeah, to some of the foreign investors, I think two things have happened. One, there was a feeling that they can't miss out on China. I mean, China has performed very well recently. That fear of missing out on a very attractive, in terms of valuations, market is something that investors do not want to do. So they've been using India to some extent as a kind of, funding part of their exposure for moving into China. I think they got caught out with the RBI dividend, to be honest, and that's why you saw a lot of buying. It's more short covering than anything else. But I think what foreign investors will do is that, once they see that, policy is going to continue, that uncertainty is taken away, given the weightages in the MSCI as well, I think they'll have to come back, and the financial sector is one area which they've, been consistently selling for some time, that they will need to come back to buy.
Sure. And you said post-election, obviously the focus will be on the budget. That will be the next big trigger. But that apart, what do you think will be the key triggers for markets from for the month of June?
I think for the month of June would obviously be, the kind of layout of the 100-day policy from the government. In terms of, is there anything different than what we were expecting? Is it, will we hear anything about the RBI dividend and how that would be utilized? Would it be, to reduce the deficit or increase spending? I think that would be one of the key events I'd be looking to see what the government want to do. And of course, we'll have the inclusion in the JP Morgan bond index, and that should see, hopefully, foreign investors come in and start buying into government bonds, and that should bring the bond yields down in India, which is again good for the banking sector. So overall, those are kind of, I would say, more market moving events, in the month of June as we head into the kind of expectations for the budget.
And how do you see the Fed piece? I mean, are we sorted that a Fed rate cut is indeed coming in September? Are risks from that front completely negated now?
I think the market is just overlooking what the Federal Reserve is saying. I mean, it's been pretty much all over the place over the past year or so. And, whilst, if you go back to November, December, when the chairman of the Federal Reserve was, very dovish, and we all thought interest rates were coming down, but inflation has been a lot more sticky. Jobs have been a lot more kind of buoyant than they were expecting. So I think the market's now saying, listen, something might not happen this year. It's okay. But money, as you probably noticed, Mahalakshmi, is not just flowing into equities, even though, most global markets are reaching new highs. It's going to other asset classes as well, whether that's gold, silver, metals, crypto, and so forth. So, risk appetite is still there, even if you're not getting the kind of performance from the index, apart from if you're holding, I'm talking about the US now, unless you're holding, one of those 7 magnificent stocks which keep going up.
Right. But again, Andrew, unless a rate cut becomes a reality, do you think FIIs can come to our markets in large numbers? Do you see a large inflow flowing in after elections? Because at least the uncertainty would have, we would have gone past the uncertain phase. But in terms of the risk on trade itself, 5.5% Fed rate doesn't allow for any room for money to flow out into risk assets in large numbers. Would you agree?
See, well, it is flowing out to risk assets, right? Because it's going into metals, gold, it's going into other asset classes, which, I could say, are not equity in that respect. So, that is something that investors are doing. I think.
So that is, how do you read that? Because that looks like more, a dollar trade than, a market trade.
We see the dollar, yeah, but the dollar hasn't really moved, has it? I mean, it's been stuck around that 103, 105 level, so it's not as though it's been a significant increase in the dollar, against other currencies. So
how do
I'm
you
not
really
sure.
explain this, Andrew, this money moving into other asset classes apart from equities? I mean, it's not that, flows into other emerging market equities has been great either. It's not just India.
Agreed, because you have one big emerging market, which there's still a debate going on about, which is China. Now we've had what an 8-9% rise in the kind of Hong Kong kind of China index, and usually the underlying China index will follow that. But it's not been a whole weight of money. So what happens is that once that once the feeling that China's really kind of hit the bottom, which most people are now betting on, then you're going to get more and more flows towards emerging markets. Now, a large proportion of that will go to China, but some of it will find its way into India as well, because of the weightages that we have in MSCI, just to keep the weightages there. So I think we will get flows, depending on how the budget goes in one aspect. But in terms of valuations, whilst we're not a cheap in terms of valuations at the moment compared to some other markets, I think it's the stability. I think it's the growth prospects in many different areas of India. So maybe the index, Mahalakshmi, is something I wouldn't look at so much. I would look at the underlying themes that are going to play out over the next 1 to 2 years, which is probably where you're going to make most of your money.
Right. You mentioned, the same stocks that have been rallying in the past, which is largely the power pack, the capital goods sector, all the economy sensitive stocks, and of course banks lately after the RBI dividend. Is that the pocket to focus on for you also over the course of the next year?
Yeah, it hasn't really changed since we spoke before. It's kind of the government spending. So we know they're going to spend on defense as every other country in the world is. Renewables, railways, those are the key areas which the government's going to spend on. Now, within infrastructure, I would kind of tend to go more towards the kind of those companies where it's more the smart cities, railways, smart manufacturing. Those are the kind of companies where I think you'll find margins will just continue to kind of move significantly higher over the longer term. And then the other themes to play out are obviously premiumization, and within FMCG, we're looking at more the beverage industry, where we think it's still a long runway in terms of growth and margin expansion. And finally is obviously the leisure sector, in terms of we're all spending more money, we're all going to be traveling more, and there's a limited amount of rooms that are going to be brought into the next 1 year. So you're going to see revenue yields there for the hotels continuing to expand, and we're all looking for new experience. So I think that's what's going to drive the hotel sector and the leisure sector going forward.
Sure. I agree with the consumption part, Andrew. With the investment-led stories, is there any particular pocket that you could call out which you think may be high priority? At least it looks like it could be high priority for the government, because within all these, whether it is the power finance companies or generation companies, renewables, all of them, they're small pockets, but railways, defense, manufacturing, all of these, but these also keep on rotating. It's not that all of them go up in a straight line. Are there any particular pockets that you think are now ripe for the next leg of the rally? And some that you think may just have gone a little overboard in terms of valuations and may see some kind of pullback or just remain at the same level?
So let me put that in slightly different context. If I take anything to do with infrastructure, and I'm talking about railways as well and defense at the same time, is share prices move on order books. So if you expect in the first 100 days or more that the government will kind of execute or give out more orders, this is what's going to push these share prices higher. I mean, we'll have to wait till see what the execution is in terms of the profitability, but that's what's going to push the share prices of these companies going forward. So I don't think it's just necessarily that you would say that the PEs at the moment, based on the order books you have, are where they are. But if that's growing by 1 to 2 times over the next 2 to 3 years, then you have to look at a different earnings projections for those companies. So I think which is a little short of that idea of the longer term prospects for some of these companies. The other sector that I should have mentioned was the electronic manufacturing sector, which I still think is at the very early stages of fantastic growth going forward. Yes, mixed results by some of the companies, but this is what you expect when an industry is trying to grow with the kind of capacities that they're trying to bring on board, and along the way, you will see those dip in earnings before you start to see the margins improve and the benefits of the capacity expansion coming through. So great sector to be in, I think, for the longer term.
Sure. What else would you be looking for from the government in the, soon after the elections? You talked about ordering for public sector, for essentially ordering by the government itself. But apart from that, anything else?
No, I think the market's been very happy with what the government's been doing in terms of leading the infrastructure spending. And of course, Mahalakshmi, as we all know, that has a multiplier effect across different parts of the economy. Whether it's then construction materials to paints to furnishings, all of these things start to play through as the expenditure continues. So I think all of these things have a big difference, and I'm sure will have a big difference in how we can commute going forward. And of course, with all the roads and highways being built, it brings itself to kind of new towns being built, hotels coming in, and then conference centers. So all of these things, it's very difficult to put you'd have to go and visit all of these places, but that's what happens. And that's where the multiplier effect really starts to kick in for the economy. And that will push earnings growth a lot higher going forward over the next 2 years.
Right. Andrew, you mentioned, the worry about capital gains tax in the budget, and that's a common worry, and I hear that from almost all market participants now. It's as if, it's already clear that it's going to come in. So how do you think that, would you see it as hugely negative for markets if there were to be some tinkering on capital gains tax?
So it depends what they offset it with. If it was, say, reduction in income tax, which obviously benefits a lot more people than capital gains tax on a smaller number of people. Maybe it's a holding period, but I certainly think they'll do something with tax on which would help the kind of banking sector. So, for example, the arbitrage funds enjoy equity taxation for a risk-free product, which is more bond-like, but has different taxation. So that could be some area that they'll look at more closely. But I think overall, it depends on what the offset is to, if there is a capital gains tax increase at all. Maybe it's another year out, the government might want to have. But you see, you can't, if you're going to get to a 10 to 20 trillion dollar economy, it can't all be funded by equity. Your debt markets have to help to build this too.
Fair enough. So you're saying in itself we cannot conclude that a capital gains hike will be so negative for the markets. Is that what you're suggesting? Because arbitrage funds, like you're saying, seems like a foregone conclusion, because every year they have been plugging some tax arbitrage opportunity or the other. And I think this is the only pocket that right now looks like an arbitrage, and assets out there have grown from, I think, 40,000 crores to more than 1,50,000 crores or so. So that looks like a no-brainer. But I'm talking about equity capital gains tax. If there were to be some kind of tinkering with that, will that have a huge impact?
So it would have an impact initially, which is always, the markets never like any tax, right? So whichever way I look at it, markets don't like. So, but once that all settles down, then you go back to the pure fundamentals, and if the fundamentals of the markets remain very strong, and the economy too, then this is still a way to make more money, in over a longer period of time. So, it's not as though other countries don't have higher capital gains tax, and the markets aren't reaching new highs.
Sure. Andrew, one last question. What is your sense on, public sector companies as a whole, considering that the valuations are what they are, nearly close to, to their peaks? Would you think there is more room for these stocks to go up?
Well, a lot of these PSU stocks land into sectors like, defense and railways, and so forth. So your choice on the private kind of side of it is limited. So of course, if orders are going to come into these sectors, they're going to land in a lot of these companies' hands. So the prospects for those companies, remain very strong. It's really, again, it goes back to Mahalakshmi, is the execution, and unfortunately, we're going to be a few quarters, few years out before we can see how well they execute. So that's a different subject. But I think if the PSU sector as a whole will continue to do well, if you take the banking sector, for example, if bond yields were to fall, it's the PSU banks which would benefit the most,
yes,
from their government holding. So you can't take that away from them and say, oh, the valuations are here and there. It's something that the market would want to price in very quickly in terms of increased share prices.
So, sorry, one last question. What do you think are the key risks from here, and what are your top 3 bets? I know that you've already mentioned banking and the premiumization trend. Anything else? And pockets of investments. But if you can pick three of your top bets.
I think I have mentioned them, Mahalakshmi. It's very difficult to have new ideas and new views in terms of our economy. It's a domestic driven economy, really. Therefore, I'd like the kind of electronic manufacturing sector, because it's not just domestic, it's also potentially exports as well going forward. So that would then depend on where the rupee is against the dollar, and whether the dollar is going to be stronger or weaker. And of course, we've got the US elections coming ahead in November. And typically, markets in the US have a reasonably good run ahead of the elections. And of course, people like Trump, because he's usually market friendly. Maybe some of his other policies are not so market friendly, but the markets like him.
Sure. And the key risks to markets from here on?
I think the key risk is as always, two things. One is complacency, in terms of if you go back a few months ago, Mahalakshmi, maybe it's an even shorter period. It was buy India, sell China, and how that reversed in terms of foreign investor sentiment. So risks of just being that we're the best, and there's only one place to kind of invest money is something we have to be wary about. And two is obviously companies in India looking at where they think it's easy money to be made without having necessarily the expertise to do that. So those are the kind of things that I tend to look at. We saw it last cycle, right? Companies deciding that they become asset managers, or asset management companies without any expertise at all. And then, it has a big drag on earnings going forward.
Oh, absolutely. Thank you so much, Andrew. It was a pleasure talking to you as usual. Thank you so much for your time.
Thank you again.